Is it going to blow up in their face, going to negative rates?
Well, I'll tell you, I mean, Chairman Powell made it pretty clear yesterday during the press conference that negative rates are not on the horizon. He went so far, really, as to talk about what the playbook is going to be should we have a prolonged downturn. And I thought that was really quite significant because there is a lot of chatter in the air about negative interest rates and whether that's going to be an important tool should the Fed want to do more in the area of stimulation.
The other question on the topic of the ECB and negative rates, Sarah, is whether, even if it doesn't blow up in their face, whether it achieves any extra growth from where we are now. I don't know if you saw the very, very tepid demand for their latest tranche of bank liquidity that they offer up to the European banks. But does it suggest that at this stage in the cycle from where we are already, there's very little that the ECB can do?
Yeah, I think that is close to being right on the mark because, of course, negative interest rates are untested. Really, we don't have good results from the times they've been tried. They've been, in place at the ECB for a while. We see what the results are there, and of course, the Bank of Japan has been living with negative interest rates for a while, again with mixed results. So I think the jury's still out on whether these are going to be an important tool that somehow get accommodated or get used by the U.S.
So at the top of the show, Sarah, we talked to Stephanie Lang, who has a pretty good pulse on the market here, and was saying that the digestion of the Fed is actually a little hawkish because he says he's data dependent. If he's data dependent, the data is not pointing to another cut. He's also got a very divided Federal Reserve, which has only grown more so, and that also doesn't necessarily point to a cut. So is that the right interpretation?
I think that is the right interpretation. You've got pragmatic considerations, which is that, Chairman Powell is now drawing 3 dissents from both sides. And so that is, he's kind of, we kind of see the fraying of a consensus. So pragmatically, yes, that would suggest that the end of easing may be signaled. And of course, the indicators. He made it very clear that he is keeping his eyes on the dual mandate. From his perspective, labor market conditions look good. He feels we are close to maximum employment. He's also signaled that monetary policy is doing better things to getting us towards that 2% inflation target. So from the dual mandate perspective, I think his focus there was to send a signal that the economy, from his perspective, is doing just what it should be.
Steph, whatever the Fed did yesterday, the rise in yields that we'd seen for the prior couple of weeks has paused. Mm-hmm. Does that mean the rotation that we've been seeing in the stock market is going to pause as well?
Well, it certainly has paused this week for sure. And I think it all depends on the economic data, right? I mean, if the economic data comes in weaker than expected, then, it's very hard to see value outperforming growth. But here's the thing that when I talked about the economic data being a little bit better than expected here, inflation is starting to creep up a little bit here. And so that is something that bothers me. Now, I know they look at the core PCE, so I get that, and that's still very tame. But the core CPI, the last 3 months, annualized, is 3.4%. That's a big number. And then the Philly Fed and the Empire and Manufacturing series, both series showed price increases, and that's not good. So it's something that we have to watch, not only the headlines and the data, but now inflation a little bit. I'm not worried yet, but there are starting to be some signs here.
Sarah, could that mean we start to see a steepening of the yield curve for the wrong reasons if we do see inflation pick up?
Yeah. So I'm not so sure that it's the inflation side that has me worried. I think we've got to keep an eye on what's going on in the repo market. Today was, the third day. This shouldn't have happened, really. It's not particularly a great sign that the Fed has to keep injecting reserves into the repo market.
Sarah, there's another operation on Friday, just crossing. Just to add to your worries. Explain why that's got you concerned.
Yeah. So, I think the Fed is going to have a timing issue on their hands. They should be thinking about whether they want to put in place a more permanent kind of facility so that they can forestall the lack of confidence that continuous injections might be instilling. At the same time, the setting up of a permanent facility itself could foster questions about the right level of reserves and why this is happening now.